The smart money pulls back. Is Buffett, Burry, and the AI bubble. The AI bubble. So basically what we have is the smart money is pulling back. We shall see what the fact is. But essentially the smart money is pulling back because Warren Buffett basically said that, listen, you know what? I am going to be a seller right now. And I am not going to be investing for a while, and my cash position is going to up and up, and therefore I'm the smart one in the room, and I am not going to take any loss because I think the market is overvalued. Now, of course, we are saying that based on what we are seeing happening. We don't know exactly what he's really thinking, and we are going to talk about this a little bit, obviously, because this is a stock market, and the stock market is very high right now. And if you believe in this famous Buffett indicator, it would indicate that the market is overvalued. Is he right? Is he wrong? I would like to remind you that he has done that in the past. Since last year, he's been a seller. Remember last year in July, he actually sold all of his position in Apple. And he missed quite a bit of the upside. Buffett in July of 2024 sold lots of his positions. At that time, they say, oops, look, he feels that the market is overvalued. What is actually going on? What is the truth? What is he doing? And then on top of that, in the market right now, the smart money in the world is pulling back. And well, they said they were pulling back, and they did, and the market actually pulled back. So Warren Buffett is sitting on a record $381 billion in cash. The biggest corporate war chest in U.S. history. And Michael Burry, the man who called the 2008 housing collapse, and I would remind you that Michael Burry in 2008 basically said the following. He said, we're going to have a housing collapse. We're going to have a housing bubble, and this whole thing is going to collapse very soon. And what did he do? He basically positioned himself by buying lots of insurance on the, structures, corporate structures, subprime structures, leveraged. You don't need to worry about the details, but the point is that he bet against the housing market because he said that all of these loans, all of these structures that are based on these loans are going to fail. They looked at him, and if you watch the movie, The Big Short, he goes into this room with Goldman Sachs, and he said, "I'm going to hedge I'm going to hedge the housing market." And they say, "You are betting against the housing market? Are you sure you want to do that?" And listen, if you want money, this is Wall Street. We'll take it. Free money, we'll take it. And they actually did that. He invested quite a bit of money. He created a hedge funds to do exactly that. And for a couple of years, nothing happened. And he was paying that cost of that insurance. But eventually, he was proven right. And he made almost $500 million. That same man is actually saying now, I don't like it. And I will tell you exactly what he's doing so you have a better understanding what he's up to. But he's basically saying that this is too much and the market is going to collapse, and I want to benefit from that collapse. So two different approach where Warren Buffett is essentially, pulling out of the market, right? Building up his cash forward. And where Michael Burry, as a typical trader, because he owned a hedge fund, he's basically wants to benefit from the collapse. So he's shorting the market. And he's again betting big against today's most crowded trade, artificial intelligence stocks. So when we're talking about artificial intelligence, we're talking anything having to do from Tesla, NVIDIA, obviously, anything that's related to artificial intelligence, because he feels that it's overdone, it's overbought. Now, I'd done a video on that in terms of is the market on AI, is this like the 1990 bubble and it's not. Okay, if anyone tries to compare the two, tries to compare the AI situation today with NVIDIA at $5 trillion, and they say, look, this is what happened in 1990. in 1999, 2000, in March 2000, when the market starts collapsing by 72% over a year and a half. They're saying, look, it's going to happen again. Please, it's not the same thing. Okay. First of all, you need to understand that at that time, these dot-com era stocks were nothing. It was a trend. It was a fad. NVIDIA is a real company, right? Tesla is a real company. Palantir is a real company. I mean, all these companies have a real product, and they have money behind them, and they have customers. Now, are we paying too much for them? Well, that's always a question. But the point is that these are real companies, so we cannot compare them equally. Now, you could both say it on both sides that, well, the market is overvalued. Well, that's true, and at that time, and it is overvalued today as well. And don't forget, you got to get it right, because in 2000, when the NASDAQ collapsed, it took 15 years to go back, right? So make sure you are on the right page. So when you have two legends, basically, of two different styles, and both of them are saying, caution. Well, you got to stop down and listen. You got to say, okay, let's listen to what these guys have to say. So what's going on with Buffett? The Buffett cash pile. So Berkshire Hathaway, basically cash and short-term treasuries, now make up nearly 1/3 of total assets. That's a lot. Buffett has been selling more stocks than he buys, trimming even long-term favorites and pausing share buybacks. Now, please keep in mind, this is not out of yesterday. He has started doing that last year before the elections result. Now, why? Why is he doing that? Well, because he believes the market is too expensive. Is the market too expensive? Well, on the basis of a P ratio, yeah, I mean, it's high. On the basis of his own calculation, he's got the Buffett ratio, basically tied to the GDP. Yes, it is at the highest it's been. And each time it's gone that high, the market had collapsed. So Berkshire is keeping his powder dry, earning about 5% risk-free on US Treasury while waiting for a market reset. Now, keep in mind that he's been losing a lot of money. Right? In the US, the market is up 15%, I think, since the beginning of the year, and it was up last year as well. So it's strategic derisking, I guess that's what you would call it. Now, does it mean that he's abandoning equities? No, he's just avoiding overpaying for them. And frankly, I would approve. When I say that the market is up, what are we saying, really? What do we mean by the stock market, right? The S&P 500, what is that? Well, you need to understand that the S&P 500 really is made up of 500 stocks, but not all stocks are valued that highly. Really, what you're seeing is that you've got about 7 stocks, the Magnificent Seven, that are driving the stock market. So, and that's why I don't really like the S&P 500, because it's not diversified. It's really highly concentrated around 7 stocks. Are you overpaying for NVIDIA? Well, yeah, right now you are. Of course, keep in mind that when we're saying overpaying, is that the present value of a stock is based on based on its future cash flow discounted as of today. So we want to know how much money the company is going to make, 5, 6, 7 years from now, and then we're discounting back the money to know exactly what it's worth today. And today, $5 trillion is a lot of money. But if over the next year or two the company keeps doing what they're doing, which is making a lot of cash, then you're going to look at tomorrow. You're going to look at it and say, wow, the company was doing great. Don't forget, at one point, the stock for NVIDIA was down to like $100, and now look at it where it is today. So, and then what happened? What changed, right? It's just people change their mind. Now, keep in mind, you have to be very careful. You have to understand that whenever you look at the news, you have to be very careful who's driving the news, who benefits from it, right? Now, obviously, are you a specialist? Do you understand what's really driving equities? Nobody knows what's driving equities. Okay. Just because these guys are basically saying it's overbought, it's going to collapse, and then you should sell. Never do that, right? You need to know what you are buying. You need to understand the risk. Right? So if you're buying a small company stock, and if you join my channel, you would find out that I'm making lots of recommendations on mostly small cap stocks because they have been neglected. I'm also making recommendation on AI stocks or on, but more importantly, right now, forget the AI business. You should focus on rare earth and also on quantum computing. That is a way to go. So you want to take a look at those as well. But the point is it overboard? Yes, it is. Should I sell? Well, I don't know. It depends when you need the money, and more importantly, what is it that you have? So what does it mean? So the Warren Buffett move basically signals that valuation may be stretched. Okay. And that macro risks like the fiscal debt, the high rates, and global uncertainty make bargains hard to find. Well, I mean, if you want to make money on NVIDIA, you are a little bit late. Okay. And with his successor, Greg Abel, preparing to take over in 2026, Berkshire wants flexibility to whatever comes next, a downturn, a takeover, or once-in-a-generation buying opportunity. Do you really think that Warren Buffett is selling all of his stocks, sitting on $300 billion in cash like you would, and wait for a buying opportunity? What do you think if tomorrow Warren Buffett decided to take that $380 billion and invest it? Right? What, you're going to buy NVIDIA? What do you think is going to happen to the stock of that company? It's going to shoot up the same way the stock shut down when it was announced that both of them, Buffett and Burry, were kind of negative. Now, I think what's going on here, really, quite frankly, is there is a transition, right, from Buffett to Abel, right? And Greg Abel is essentially taking over, and maybe they want some flexibility, and they don't want to start the year with a huge bath if should there be a downturn. But at the end of the day, I don't think this is them holding off that kind of cash. They would never be able to invest that money without moving the market. Now, of course, when I ask people, who's the most, successful investor of all time, everyone says Warren Buffett. Warren Buffett. He's not. Think Jim Simmons, $40 billion, manager of a hedge fund, mathematician, right? Think about that guy. He managed 30% return for 20, 25 years. How did he do it? Buying small pieces of opportunity in stocks and trades in a very, very, very targeted way. He certainly didn't walk around with $300 billion in cash looking to invest it. This is an easy story to sell it to you, right? But not like that. But there's an opportunity cost, right, for what the Berkshire is doing. While Berkshire stock rose about 6% this year, the S&P climbed more than 16%. Like I told you, 16%, 15%. By holding cash instead of chasing the rally, Buffett may have left roughly $20 billion of potential gain on the table. I guess it's called patience or underperformance. I think what it is, it's something that you don't know, and it's a little more complicated than that. Again, nobody sits on $380 billion in cash. What is Michael Burry doing? Well, on his end, he's taking the opposite approach. Instead of parking cash, he's placing large directional bets against the market. How do we know that? Well, if you look at this Scion Asset Management regulatory filings, he's holding a massive amount of put option positions. What does that mean? Well, basically, he's buying protection. I guess he's looking at a fat tail where is an unlikely event that's going to make him lots of money because nobody is being negative on the market. So basically, he's buying a put option. He did that, by the way, he did that last year. And I don't think he made that much money on it because he was totally wrong. So please, I'm using these two guys as a way to explain to them my thinking, and unfortunately for you and I want my subscribers and my members to understand that this is a little more complicated than that. Just don't buy what somebody else is buying. Of course, he did pretty well because since he put a put option and you guys sold your stock and the market went down 2%, I can imagine how much money he made. But Barry's long position in value like Estee Lauder, Lululemon, and Regeneron are small and selective. Yeah, he I think started last year. He started playing around and, no stocks, mostly options. put options on the S&P on AI. And frankly, there are many ways, and I will tell you in my Patreon channel, and also as members, I will show you, how can you make money, being negative on AI. Yeah, you could buy plenty of ETFs that do exactly that. You make money while the market. For ordinary investors, there are now specialized ETF that let you mirror or oppose those kind of moves without actually buying options. Because the problem with options is you may think, the market is going to collapse in 6 months. And if you're right, you can make lots of money. But if nothing happens, you lose all of it. What you can do is you could potentially buy a leverage ETF that that basically mimics whatever it is that it's tracking. And if whatever it's tracking is losing 2 times, you could make 2 times. Or you could lose 4 times if it goes up. It depends the direction. For example, you've got some ETFs that seeks to deliver twice the opposite of an AI big data index. You also have other ETFs that doubles the gain if that same index rises. And again, I will share that to you. I share that to my members. In Europe, you could do the same thing. So there are many ways you could play this, where you could either don't buy and just sit on the side, but frankly, can you afford to do it? Don't forget there is such thing as FOMO, fear of missing out. Because this year, if you didn't do anything, of course, this year you should be buying in Europe. But regardless, if you bought this year, you could have made 13%, almost 15%, just holding the S&P. But the point is that you don't want to miss out either. Why? Well, listen, it's overpriced. Yes, it's overdone. But we are in the midst of a huge shift. Lots of people are losing their job because of AI. But there's a lot of opportunity coming through the AI, the data centers, new jobs are being created, that the whole thing is changing. And we have not seen quantum computing, which is 10,000 faster than your regular computer. So think of it as if you were at the dawn, right, of the 20th century when, hey, look at this thing. It's called a car. What do we need that for? What kind of, right? The whole industrial revolution is coming in here. AI is going to be huge. It's changing everything. And then quantum computing is going to make even more. Now, of course, there's a lot of uncertainties. Right? And that volatility is what's killing it. But the point is, you can benefit. You today can buy a stock that's going to do very well if AI doesn't do well. And I could show that to you. So this instrument can multiple returns, but also magnify the losses, by the way. So this is literally for tactical traders and not long-term investors. You can't just hold that thing forever. But if you think that in the next 3-4 weeks, this whole thing is going to collapse, then yeah, by all means. The easiest thing to do, of course, is not to try to time the market because no one knows what's going to happen to the stock market. What you should do is if the market is going down and you feel positive, then you should be buying. Buy. That's what I tell my subscribers, and I tell them what to buy. And if they're done what I told them to do, and I show them my trades all the time, you could see the returns that I have on my little portfolio. Medical robotics. That is a developing field, believe it or not. I've heard about it. I don't know too many stocks because I can't follow everything. But I will tell you that right now, basically what we're talking about is you don't need a surgeon anymore. No, because this thing you lay down and this thing measure you. They do that in China. They soon, believe it or not, they're going to open. Amazon is replacing all these people with robots. If I say robots, you should say Tesla, right? Don't forget, they're also going to be selling $10,000 robots. No one is paying attention right now. And that's what I mean, that so Tesla is in this environment. Keep in mind that, of course, there are going to be losers and winners and losers, right? Big loser of the beginning of the century was obviously Tesla himself. Genius, but nobody paid attention to him. He got taken over with Ford and Edison, right? Read the book and you'll see. So there's a lot of uncertainties, but things are definitely changing. This thing is not going back anywhere time soon, right? These people at Amazon, with Meta and all these companies And Tesla is spending a tremendous amount of money on AI. And it's for a good reason, right? So you want to be part of that. So whenever you see this kind of weakness that you saw recently at down 2%, of course, the market is back up again. Don't lose that opportunity. So when you step back, there's a pattern that emerges, right? Buffett is quietly de-risking, and Burry is loudly shorting, and Wall Street is investing new ways, right, for the public to bet on or against the very small AI theme that's driving market euphoria. It is a tug of war between disciplining exuberance, between cash preservation and leveraged speculation. Now, Buffett's patience could look boring today. Now, let's be careful again when we hear about Warren Buffett. Because, like I said before, you just don't sit on $380 billion of cash. For the reason of, well, I'm waiting for the market to go down, then I'm going back in. You don't go back in with 380 billion. Because the same way you go out and the same way you go back in, everybody's going to be buying stocks and you're going to miss out the way a guy like Jim Simmons makes money is that he takes very small, tiny positions all over the place and he makes tiny amount of money, but thousands of times over. Don't think that Warren Buffett is sitting on $280 billion. He's waiting for NVIDIA to go down and then I'm going to buy NVIDIA now. No, it doesn't work that way. So, but it makes for a good story. People listen, say, wow, Warren Buffett is selling, so that's not good. I will tell you one thing. In 1987, October 19th, the stock market went down by 20%. The odds of such an event was 10 to the power of 50, but it did happen. And at that time, someone went out and did a survey for the government and basically for Yale, went out and they wanted to know exactly, what caused the stock market to collapse. So they went around and they asked, why did you sell on that day? Let me tell you, no one knew exactly what happened. There were several reasons. They felt the market was overpriced, but no single news caused the market to drop. So we didn't know then what drives the market. We still know it today. So do not try to time the market. Do not listen to someone that tells you they know what's going to happen next, because no one knows. You should be like Socrates. You should get up every morning and say, I know that I don't know. Right? Therefore, what we should be focused on, the risk. Right? When you cross the street, what do you do? What's your goal? What's your main goal? Your main goal is not to cross the street. Your main goal is not to be run over. So you need to be aware about the risks. And then you'll be much better off later on. Right? In every market cycle, you should know that the biggest fortunes are made not when everyone's chasing gains, but when the patients are waiting in cash and the brave are shorting the excess. You make lots of money shorting the market. The only thing is you have to be careful. But essentially, what's happening with Berkshire? Well, and let's talk numbers here. Let's talk detail, right? So basically, Berkshire Hathaway cash and short-term position have reached a record level of about $381 billion as of third quarter 2025. And of course, it generated about $13 billion of operating earnings, largely driven by its insurance business. Meanwhile, Berkshire has been a net seller of equity for many consecutive quarters and has not been buying his own share because I guess he feels it's too expensive. The reason being cited, Buffett and his team believe there are fewer attractive bargains in the market now. So they are holding cash until better opportunity emerge. I would like to hear it from Buffett's mouth himself. But what I think is happening, because Buffett is nearing his transition from CEO to handing over leadership of Berkshire to Greg Abel, who will be CEO around January. So Berkshire is sitting on his huge cash pile into that leadership change. That makes more sense to me. Now, why this matter? Well, cash is opportunity, right? Holding hundreds of billions in cash means Berkshire has enormous flexibility, but not enormous possibility to make lots of money, right? You don't make money, right? Like that. It's a sign of caution. That I would agree. It's a sign of caution. It signals Buffett believes the market is expensive. But that, of course, it's expensive, right? But it's expensive for a reason. It's expensive because everyone expects lots of gain to come from those companies. By the way, GDP in the US is 3%. By the way, rates are coming down. Okay. By the way, a humongous amount of money is being invested in the US. By the way, the money from tariffs alone is going to be almost $1 trillion by next year, if they are legal, and I'll do a video on that. But the point is, there's lots of good things to look forward to. And just because Warren Buffett is saying I'm holding off cash because for some reason doesn't mean that you should be out. So is this a defensive move? Well, it certainly looks like it. For shareholders, cash isn't necessarily earning as much as investing in good business. So there's some waiting there. I mean, imagine you're a shareholder of Berkshire. You say, what are you doing? You're sitting on $381 billion. How much money are you making? Well, making 5% free. Well, you could have been making 13% or even more. What is the point? What are you doing? Now, with Buffett, Warren Buffett basically stepping down, how and when this cash is deployed may reflect the approach of his successor. I think this is more like it. So, Warren Buffett, not the buffet, okay, is stepping down soon. How can this cash is deployed? Let's find out. So basically, when someone like Buffett, let's call him Warren, when someone like Warren sits on that kind of cash, it raises question about market valuation, availability of deals, and the macro environment. And frankly, we shouldn't even say Warren Buffett. We should say Berkshire. Right? He doesn't walk around with that money in his pocket, quite frankly. So what to watch and potential risk? Well, will the cash be deployed? Will Berkshire make a large acquisition, increase shareholder buyback? We don't know. So far, the deployment has been modest and relative to the war chest. If Berkshire holds cash long enough and the market continues to run higher, his performance might lag. And in fact, it's already lagging. He's making 5% when everybody else is making 15, 13%. Of course, as a downturn, he's going to look smart. But, a market crash that everyone is talking about, keep in mind that for you to have a crash, right, you need either a lack of liquidity, you need a recession, you need something major. Not just thinking, it's too expensive. No, that's not enough. And then the opportunity cost, the cash cushions earn low returns compared to what owning high-quality businesses has historically yielded. So the longer the cash sits unused, the more many may question that strategy. So basically, the Berkshire positions, what they're basically saying is, we see few good deals right now, we're waiting. Or they're also saying, well, we're in the midst of a transition ourselves, so we'd rather hold our cash and maybe, decide what we're going to do with it at some point. So what should you be looking for? Well, obviously look for any announcement or major acquisition, changes in share buyback policy, valuation, right? Because keep in mind, you're not going to put $380 billion to work right away in the stock market. You're going to drive up prices. So that's not going to happen. So is this a de-risking strategy? Well, obviously, because you're selling and you feel that the market is overstretched. It's too much. Why we're saying it's de-risking, it's risk management? Well, over 30% of Berkshire's total assets are now in short-term treasury. That's a lot. And cash equivalent. it was the opposite in 2022. So he sold billions of stocks over the last 4 quarters. He trimmed Apple, oil and gas, financials, right? But not that he needed the money. There was zero buyback lately. So it's not like he found any opportunity to buy his own stock. And frankly, maybe he doesn't have to do anything. Why? Because the insurance side is generating strong float and premium income. Maybe he doesn't need to. You have to understand that Berkshire's, right, is famously macro agnostics. What does that mean? Well, when you have a fiscal position in the U.S. of $35 trillion, when you owe $35 trillion in national debt and growing Treasury, you earn good return on risk-free rate. Because don't forget, at the end of the day, it's not so much how much what your return is. Are you getting paid for the risk? When you cross the street, right, you're thinking, what is the likelihood I'm going to be run over? You do that, right? Because you don't close your eyes and cross the street. You look left, you look right. You kind of measure the distance between the cars or whatever obstacle there is in its way. And then you cross the street. That's what you should be doing. Was it worth it for you to cross the street at this particular time? And that's what they're doing. And right now, with $37 trillion in the economy and basically fiscal deficit, that's a lot of money. There is a geopolitical risk premium. China and the U.S. is decoupling. I did a video 2 days ago, I think, on the fact that the U.S. is kind of playing war games all over the place. Why? Do they see something we don't? Well, they don't do it officially. They're going after the drug dealers of Venezuela. But maybe they're practicing, right, for something else. We've got Russia out there with a shadow fleet doing its thing. That is what I would worry about. And then, of course, you owe $37 trillion. That's a lot of money to owe. So for these reasons alone, I would definitely buy some kind of long-dated put on the market, like a 2026 put, just in case something blows up somewhere, while still making some money in your portfolio. Now, Buffett isn't turning bearish on capitalism or abandoning equity long term. He's de-risking temporarily but strategically. We shall see. We shall see. But what would reverse his de-risking? Well, let's see if he buys lots of equity. Let's see if he does a mega deal. An acceleration in share buyback. Lots of things could be happening, right? We need to see. I mean, how much money, but the thing is, keep in mind, how much money did he actually lose, right? Because he didn't invest. So he's not so smart right now. Because he's earning 5%, but he could have been making more money. So with $381 billion in cash and equivalent, is the Berkshire share were up 6% for the year, while the market was up 16%. Right? If you were to do a long-term comparison over the market cycle, 2008, the S&P returned 200%, while let's see if you start in 2008, right, and you measured, the S&P returned about 200%, while Berkshire returned 170%. So you kind of underperform the market a bit because of what you did. Rough return of missed return estimate, if you want to ballpark on how much Berkshire might have missed by holding cash, because he's been holding cash for quite some time. Suppose the $380 billion was instead invested in the S&P 500 at 10% return. That's about $38 billion per year. Instead, the cash was earning safe short-term yields, 5%, $19 billion. So that's a lot. So the longer he holds it over multiple years, that adds to about $57 billion missed opportunity over 3 years if that keeps on going. You have to think about that. But of course, this ignores risk. The chance that the market can be down instead of up. And that's the idea. Let's see. Let's see what happens. Buffett's cash strategy is partly risk management, so maybe that's what he's doing. I'm not so sure. We shall see. But basically, if you compare Berkshire total return to the S&P, we're comparing a diversified conglomerate to a pure equity index. So that's not really easy to measure. But the point is that he lost the money. So what is Burry making? What is the Michael Burry? Michael Burry from Scion Asset Management. What is he doing? Well, in the first quarter, what he did is the following. Scion reportedly exceeded nearly all of its equity holdings in first quarter of 2025 and shifted to the large put option. NVIDIA, Alibaba, and NVIDIA. In second quarter, he shows a pivot. His portfolio has only a handful of holdings or covering names like Estée Lauder, Lululemon, blah, 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 and significant meeting. Recent in November 2025, there are a news report of extremely large put option. He's been going put on NVIDIA and Palantir Technologies in November 2025. And that's why those two stock, the market got hit by 2% because of that. Barry's commentary has included signaling concern about valuation and bubbles. He says basically sometimes we see bubbles, sometimes the only winning move is not to play. So what is he doing and why? Well, I think at the end of the day, his move to large puts suggests he thinks part of the market are overvalued, especially in the AI tech growth complex. I will show you that on my Patreon channel and with my subscribers, but more importantly, my members. The use of put option indicates the exposure could benefit if the underlying stocks decline significantly. So overall, Michael Burry is currently not in a relaxed buy and hold. He's playing a high conviction, concentrated directional bet. So the question is that, what is the stock market going to do next? Right? How do I know? You need to stop thinking in those terms, unless you're a day trader. What you should start thinking is in terms of risk management. Not how much money you make, it's how much money you keep, right? No one knows what's going to happen to the stock market. Think of the stock market as you looking at a tree. When you look at a tree, and this is exactly what one of the famous hedge fund managers, guru, who follow him quite a bit, Mandelbrot. Mandelbrot is basically famous for his talks on fractals. And basically what Mandelbrot said was that if I were to look at a tree, can I predict what his branches are going to look like? Can you do that? Possible. Yeah, but hold on. I may not be able to predict what the branches are going to look like, but I do know that it's going to follow a certain pattern for me to kind of understand and realize that this is a tree. Right? So the tree does its thing, but it doesn't do crazy thing. Not pure chaos. Right? And that's what the notion is, that there is a way to predict the stock market. No one has found out yet how to do it, but it is not purely random. There's a certain pattern to it, right? And that's what you're trying to do, but that's almost impossible. But one thing I could tell you is the fact that it is risky. So what you should do is you should focus on measuring the risk of your portfolio. How do you do that? Well, there's the beta that's always published, but you can't go by that. Right? Because the beta basically look at systematic risk. The beta look at historical records. You want to know what's going to happen next. And this is why a channel like this is important. Why? Well, because what we do all of the time, we look for events such as a black swan. And keep in mind, the black swan, after the book, The Black Swan, really, by Taleb Nassim, who was a big follower of, I give you, Mandelbrot, French mathematician. It's all about the mathematics. that you need to understand and grasp. Otherwise, it's just news and entertainment. They make money, but not you. So follow me, understand what's happening, learn, analyze, and you will make money.